Today, let me introduce you to the book, Where Does Money Come From? This book answers how money is created and distributed in modern society, and its significant socioeconomic impacts. Before we get started, please click on the subscribe button below to stay updated and support Daily Book Dive. When discussing the origins of money, you might think it's straightforward. Just look at the bills and coins in your wallet, which are printed by the central bank. However, these notes and coins constitute only a small fraction of the total money supply. For instance, today, in most countries' monetary structures, only 3% is cash issued by the central banks, with the remaining 97% created through other means. You might not believe it, but in the modern economy, the majority of the money supply is created and distributed by commercial banks through credit. This means that whenever someone takes out a loan to buy a house, car, or start a company, new money is created. In other words, the vast majority of the money we use every day is controlled and distributed by commercial banks, and everyone participates in its creation. Moreover, you might not expect that in a bank's operations, there is no need to use deposits to issue loans. But instead, loans can create deposits. The constraints like the capital adequacy ratio and the reserve requirement ratio are very limited in restraining commercial banks from creating money. What really matters is the confidence of the banks. In other words, banks are not intermediaries in the lending of money, but are the source of money creation for the economy. The role of central banks in the creation of money is much more passive than many might imagine. This book's conclusions are startling but seriously argued. It is authored by 4 British financial scholars, through the review of over 500 documents and guidelines from central banks, regulatory bodies, and other financial institutions, and it has received endorsements from authoritative scholars. For example, Sir Charles Goodhart, a member of the British Academy and the proposer of Goodhart's Law, recommended this book. As he suggested, the frontier of financial knowledge is not in research institutes and classrooms but at the counter and negotiation table dealing with clients. By the time this knowledge is written into papers and incorporated into textbooks, it is already outdated and no longer fresh. Thus, the knowledge shared in this book is more real, accurate, and cutting-edge than what we find in textbooks. Of course, regarding the creation and distribution of money, it's not only a knowledge issue but also a matter of interest. Because the credit money created by banks does not flow evenly. Due to incentive mechanisms, banks are more inclined to lend to clients who have collateral or assets, rather than to productive investments. Hence, the additional funds are more likely to flow into real estate and financial speculation, rather than to small businesses and manufacturing, affecting the interests of different social groups. Therefore, the content of this book is worth everyone's attention. Next, I will interpret this book in 3 parts. The first part discusses how money is created and the role banks play in this process. The second part examines how the amount of money created by banks is determined and the role central banks can play. The third part discusses where the money created by banks goes and its significant impact on the socio-economic landscape. I hope this exploration will unveil the mysteries of money creation and help you understand your position and interests within the modern financial system. First, let's see how money is created, or rather, where the money we use every day comes from. For this question, ordinary people might think that money is simply printed by the state. Or those with some economic knowledge might believe that money is issued by the central bank, which, through the so-called fractional reserve system, along with the deposit lending cycle of commercial banks, forms the circulating money. For example, a town has a bank where the central bank sets a reserve ratio of 10%. A worker deposits $1,000 into this bank. The bank keeps 10% as a legal reserve, which is $100, and then uses the remaining $900 to give a loan to a farmer. The farmer buys furniture from a carpenter with this $900, and the carpenter deposits the $900 back into the bank. The bank again reserves 10%, which is $90, and then loans the remaining $810 to a stonemason, and so on. This process continues, each time creating new loans and deposits, eventually increasing the money supply up to $10,000. This is the money multiplier model told in textbooks. According to this model, most people think that banks are merely financial intermediaries that circulate money and cannot determine the money supply in the economy. The real control over the money quantity lies with the central bank because it can issue new base money and set the reserve ratio. And the growth in the money supply is constrained by the reserve ratio and the base money. But this book tells us that the reality is not so. In reality, in many countries, the reserve requirements are very low, even zero, which hardly constrains commercial banks from lending. And in the operations of banks, there is no need to use deposits to issue loans, but loans can create deposits. So, in modern society, most of the circulating money is created by commercial banks. To illustrate this point, let's consider a case. Peter wants to renovate his house, but he does not have enough money. So, he goes to the bank A wanting to borrow $100,000. The bank reviews his salary slip and credit record, finds him a reliable customer who can repay on time. So the bank and Peter sign a contract stating that Peter must repay the $100,000 plus interest to the bank within 3 years. This contract is a valuable asset for the bank because it represents the money Peter owes to the bank, and the bank will record this money on its assets. Meanwhile, the bank opens a new account for Peter and credits $100,000 to it. This $100,000 is a deposit for Peter and a liability for the bank, as Peter can withdraw the $100,000 at any time, so the bank also records this money on its liabilities. Just like that, the bank expands its balance sheet, but in fact it just entered some numbers in the computer, representing the lending relationship between it and Peter. This loan allows Peter to spend up to $100,000 using his card, checks, or transfers from this account. This is the process of loan creating deposit, or credit creation. The numbers the bank entered in Peter's account can be used as money, so it functions like currency. Now, let's assume Peter needs to pay his rent to his landlord Calvin with this money. What changes will occur in the bank accounts? If Peter and Calvin are at the same bank, then the transfer is simple. Peter just needs to inform the bank, and the bank will change the numbers in the computer, deducting $5,000 from Peter's account and adding $5,000 to Calvin's account. This way, no cash is needed, and there's no need to involve the central bank. But if Peter and Calvin are at different banks, for example, Peter is at the bank A and Calvin is at the bank B, then the transfer becomes a bit more complicated. One method is that Peter withdraws $5,000 in cash and hands it to Calvin, who then deposits it into his account. Obviously, this method is inconvenient. Banks have two better methods. One method is that banks can use their accounts at other banks to directly transfer the funds, just calculating who owes whom in the end. This is called bilateral clearing. Another method is that banks can use their accounts at the central bank. Just like we have an account at a bank, each bank has an account at the central bank called a reserve account. Similarly, just as we must maintain enough balance to make payments, each bank must also maintain a certain reserve balance to make payments to other banks. When a bank's reserves are insufficient, it can sell securities to the central bank to increase its reserves, or it can directly borrow from the central bank to increase its reserves, thus expanding the balance sheet of the central bank. So, if Peter pays Calvin $5,000 across banks, how will this be handled in the accounts? Let's explain in 5 steps. First, Peter tells the bank A to transfer $5,000 to Calvin. Second, the bank A changes the numbers in the computer, deducting $5,000 from Peter's account. Third, the bank A tells the central bank to transfer $5,000 from its reserve account to the bank B's reserve account. Fourth, the central bank changes the numbers in the computer, deducting $5,000 from the reserve account of the Bank A, and adding $5,000 to the reserve account of the Bank B. Fifth, the Bank B tells Calvin that his account has increased by $5,000. Thus, the transaction is completed. What's the result? The balance of reserves at the central bank remains unchanged. The Bank A's reserves are deducted by $5,000, and the Bank B's reserves are increased by $5,000. The Bank A's liability for Peter's deposit decreases by $5,000, and its asset of reserves at the central bank also decreases by $5,000. The Bank B's liability for Calvin's deposit increases by $5,000, and its asset of reserves at the central bank also increases by $5,000. This way, the balance sheets of the central bank and the various banks are balanced and equal. As mentioned, in contemporary society, aside from a small amount of bills and coins, most of the money is just digital records and computers. Whether it's our deposits or the central bank's reserves, they are just some form of computer data. And in the operations of banks, there is no need to use deposits to issue loans, but loans can create deposits, with commercial banks being the main source of money creation. But then you might ask, can banks create money without limits? Second part. This relates to what we are about to discuss. What factors do banks consider when creating money, and what role can the central bank play in it? We can look at this from three perspectives: interest rates, reserve requirements, and capital adequacy ratios. First, let's look at interest rates. People usually believe that the amount of money created by banks is controlled by the central bank adjusting interest rates. The higher the interest rates, the greater the earnings from bank lending, but the greater the burden on borrowers. If interest rates are lowered, the bank's earnings decrease, but the pressure on borrowers is reduced. The central bank can adjust interest now rates according to the economic environment to influence the scale of credit and money supply. However, this book tells us that the main factor determining how much banks lend is not interest rates, but the bank's confidence in the borrower's ability to repay debts, and their confidence in the stability of the financial system. Banks place more emphasis on avoiding loan defaults, and the importance of obtaining high interest rates is not as significant. Because once a loan default occurs, the bank might lose all of its principal. If banks are confident about the future economic situation, they will issue more loans and create more money. Conversely, if they are not confident about the future economic situation, they will issue fewer loans and create less money. So, the scale of credit and a country's money supply depend more on the bank's views of the future. Next, let's look at the reserve requirement ratio. This is the ratio of cash or other liquid assets that commercial banks must keep at the central bank for emergency or transfer purposes. Generally, we believe that the higher the reserve requirement ratio, the less money banks have available for loans or investments. The lower the reserve requirement ratio, the more money banks can lend or invest. The central bank can control the creation of credit and money by adjusting the reserve requirement ratio. But in reality, the ability of banks to create new money is not greatly related to the amount of reserves they hold at the central bank. As mentioned earlier, in many countries the requirements for the reserve ratio are very low. For example, during the financial crisis, British banks only needed to keep $1.25 of reserves for every $100 of credit issued. Because banks participate in electronic clearing systems that perform multilateral netting at the end of each business day, they actually only need to hold very little reserves to meet payment requirements. The authors even believe that it is not the central bank that controls the scale of commercial banks' credit, but rather the commercial banks that determine the amount of the central bank's reserves, because the central bank needs to meet their reserve requirements to ensure the normal operation of the financial system. Finally, let's focus on the capital adequacy ratio. The so-called capital adequacy ratio is actually the ratio of a bank's own capital, such as share capital, retained earnings, etc., to its risk assets, such as loans, etc., which reflects the bank's ability to bear losses on risk assets with its own money. According to international conventions, the capital adequacy ratio of banks should be above 8%. That is, for every $92 of loans issued, there needs to be $8 in support. So many people believe that the capital adequacy ratio can limit the scale of bank lending and assets. But the authors of this book believe that the capital adequacy ratio does not restrict credit creation. Because retained earnings can be counted as capital, if a bank has strong profitability, the more profits it retains, the more loans it can issue while still meeting the capital adequacy ratio requirements. For example, if a bank profited $1 million last year, and $500,000 of it was retained as profits and counted as capital, then it now has an additional $500,000 of capital, which can support $6,250,000 of new loans. If the bank maintains good profitability, then it can continue to expand its loan scale while still meeting the capital adequacy ratio requirements. Of course, if the bank's profitability declines, then the scale of capital that can be retained will decrease, and the corresponding loan scale will also be restricted. But this is not because the capital adequacy ratio requirements directly restrict the issuance of loans, but because the bank's operating conditions affect its loan capacity. Therefore, although the capital adequacy ratio requirements affect the bank's risk-bearing capacity and loan scale, they do not directly restrict credit creation. What really affects credit creation is the bank's profitability. Moreover, increasing the capital adequacy ratio does not necessarily prevent banks from increasing credit during good times. This is because, first, during periods of economic prosperity, asset or collateral values usually rise, which reduces the bank's estimation of loan risk, thus also reducing the need for capital, allowing banks to issue more loans while maintaining the same capital adequacy ratio. Second, optimistic estimates of economic prospects will also encourage banks to issue more loans, generate more profits, increase capital, and allow banks to issue more loans. Third, if regulatory authorities raise the capital adequacy ratio as a countercyclical macroprudential policy, banks will find it easier to raise more capital. For example, funds for purchasing newly issued preferred shares are ultimately also created by the banking system, and the funds created during prosperous periods will also increase. So we must not forget a key fact. Banks are the creators of the money supply. Requiring banks to raise more capital during prosperous periods cannot prevent prosperity. Because this prosperity is caused by an increase in bank credit, banks can use a part of the money supply expansion to finance a higher capital ratio. So the capital adequacy ratio does not restrict the creation of money, nor does it restrict the expansion of the bank's balance sheet. In summary, the money supply in modern economies is actually created by credit, and policies like interest rates, reserve requirements, and capital adequacy ratios have limited influence on credit creation. A country's money supply is mainly determined by the bank's expectations for the future, the result of various banks' lending and asset purchase decisions. Third part. Though, where does the money created by banks when they expand the money supply go? And what impact does it have on the socio-economy? Regarding this issue, first, it's important to clarify that when banks create credit, whether the money is used for GDP transactions or non-GDP transactions makes a big difference to the economic impact. GDP transactions refer to transactions related to production and consumption, such as purchasing goods and services, investing in fixed assets, etc. Non-GDP transactions refer to transactions related to the transfer of existing assets, such as purchasing real estate, stocks, bonds, etc. When banks create credit, if the money is used for GDP transactions, it will promote economic growth and employment. Because these loans are used to produce new products, new services, or improve productivity, they can increase the total demand and supply in society, leading to non-inflationary growth. This type of credit creation is productive, enhancing societal welfare and economic efficiency. But if the money is used for non-GDP transactions, It will lead to asset price inflation, bubble bursts, and misallocation of resources. Because these loans are used to purchase existing assets, they do not increase the total demand and supply in society, but only drive up asset prices. When asset prices rise, people feel wealthier, leading to increased consumption spending, causing inflation. At the same time, banks will also loosen lending standards due to the appreciation of collateral, further exacerbating credit expansion and asset bubbles. When the bubble bursts, asset prices plummet, and banks will also tighten lending standards due to the decline in collateral value, further exacerbating credit contraction and financial crises. This type of credit creation is non-productive, harming societal welfare and economic efficiency. So, which type of transactions do banks prefer to lend to in practice? The answer is non-GDP transactions. Because incentive mechanisms determine that banks are more willing to lend to customers who have collateral or assets, rather than for productive investment loans. Because the former is lower risk, higher return, less regulated, and less competitive. Therefore, during credit expansion periods, incremental funds are more likely to flow into real estate and financial speculation, rather than to small businesses and manufacturing. This has profound impacts on the socio-economy. We can illustrate this with two cases. The root of the 2008 global financial crisis lay in the credit bubble in the U.S. housing market. Under relaxed regulation and low interest rates, American banks issued a large number of subprime loans to credit-impaired homebuyers, which were packaged into financial derivatives and circulated globally. When house prices rose, these loans seemed safe and both banks and investors made a lot of money. But when house prices fell, these loans became unrepellable, trapping banks and investors in difficulties, leading to financial crises and economic recessions. The outbreak of the COVID-19 pandemic in 2020 also had a huge impact on the global economy. To cope with the demand contraction and supply interruption brought by the pandemic, governments and central banks around the world took unprecedented fiscal and monetary stimulus measures, greatly increasing public spending and credit creation. These measures alleviated the pressure of economic downturn to some extent, but also brought inflation risks. In the process of rescuing the crisis, some countries adopted quantitative easing policies. When interest rates were already at zero or close to zero, central banks increased the supply of base money by buying long-term bonds such as government bonds, encouraging spending and borrowing. It helped improve market confidence and alleviated the impact of financial crises and economic recessions to some extent, but it also had the problems mentioned above. Because central bank bond purchases do not directly create new credit for households, businesses, or governments. Instead, the financial investment sector might create new credit, possibly investing this purchasing power in corporate bonds or stocks, or in derivative trades of commodities like oil, driving up these assets' prices. Meanwhile, companies that can issue bonds or stocks to raise funds might choose to use these funds to repay existing bank debts, rather than invest in productive activities. This creates a contradictory effect, where the amount of credit creation reduction is exactly the same as the increase in quantitative easing. After obtaining additional reserves from the central bank, the banking industry can choose to expand loans to the real economy, or simply sit on the reserves. The central bank pays 0.5% interest on reserves, making them the most liquid asset banks can hold. If banks do indeed use this additional liquidity to create credit, they might also use it for transactions that can increase profits but do not contribute to GDP, such as mortgage loans, foreign exchange trading, or commodity speculation, etc. In summary, the increase in the money supply does not necessarily promote economic growth. It depends on where this money is used. If we want to achieve sustainable development, we need to change the incentive mechanisms of bank credit, guiding more funds into productive investment rather than non-productive speculation, so that newly created money can benefit society. The book Where Does Money Come From? is written by 4 British financial scholars based on frontline data and expert interviews, using plain language to compile a handbook on money and banking knowledge. While deeply analyzing monetary and banking theory and the history of financial development, it also proposes some new theories that overturn traditional concepts. The most important point is that the money supply in modern economies is largely created by commercial banks through credit issuance. It also emphasizes several points. First, in the real world where information is not fully transparent, credit is distributed by banks. The main factors determining bank lending are not interest rates, but the bank's confidence in the borrower's ability to repay the loan and their confidence in the liquidity and solvency of other banks and the entire financial system. Second, although capital adequacy ratio requirements have some effects, they cannot, and do not, restrict the creation of money, nor do they necessarily restrict the expansion of banks' balance sheets. In other words, the requirements for capital adequacy ratios are generally ineffective in preventing excessive credit expansion and asset price bubbles. Third, banks determine the direction of credit in the economy. Due to incentive mechanisms, banks are more inclined to lend to customers who have collateral or assets, rather than to productive investment loans. Therefore, the additional funds are more likely to flow into real estate and financial speculation, rather than to small businesses and manufacturing, which has profound impacts on the socio-economy. These viewpoints are important for us to understand the operation of the monetary system, improve the regulation of monetary policy, and enhance the effectiveness of financial supervision. Finally, it's worth noting that although the government does not directly participate in the creation and distribution of money, it doesn't mean the government has no influence on money. On the contrary, it is precisely because of the government's endorsement that money can become a universal pricing unit and means of payment. Only a responsible and creditworthy government can shape a stable currency. The original book link is attached at the end for further reading. You can also click the share button below the video to share this book with your friends. Congratulations, you've just finished another book.